So now let's go ahead and talk about alternative assets and how they can provide higher yields and better portfolio diversification through the use of low and uncorrelated assets in comparison to bonds in this low yield environment. So what do we really mean when we talk about alternative assets? Alternative assets are basically non-traditional investments. So not stocks, not bonds. And when we talk about alternative assets, we're talking about, hedge funds, private equity, real estate, life settlements, which is a key area that my firm deals in, and other, non-stock, non-bond types of assets. So let's just break down the pros and cons real quick, and before we get into the next section. Well, the benefits of alternatives, like we talked about, is in comparison to the bonds in this environment, is that they can provide higher returns, right? So you're getting a higher return, and often a higher risk-adjusted return than bonds. Again, you can get a better portfolio diversification, especially if it's uncorrelated to the market, which means, if the stock markets go down, your alternative asset, the value of your alternative assets aren't also going down. Same thing with interest rates, right? If interest rates go up, you're not necessarily seeing a drop or a markup in the valuation of your alternative asset. And that's why they can be a great tool in providing a portfolio diversification, just like how bonds used to play in a higher yield environment. So now let's go ahead and take a look at the disadvantages of alternatives, right? Well, for a lot of alternative assets, you need to really be an accredited investor, and those often come with high investment minimums. So they can be as high as 250K, 500K, or more, right? Depending on the fund, the structure, the portfolio manager, etc. Obviously, now with the rise of interval funds are making alternative investments a little bit more accessible through lower minimums. But primarily, a lot of alternative assets are only available to accredited investors with those high minimums. So the other issue with alternative assets is they can be illiquid, right? So they typically require a longer investment horizon than your traditional investments, which you can enter today and then exit 5 minutes later, right? So a lot of these have a lockup period where they require you to invest your capital for 2 years or sometimes longer before you can start to pull out your principal and gains. So again, they can be illiquid and require a longer investment horizon than your traditional investments. The other issue is that they can be taxed at high ordinary income rates. So some alternative assets are tax efficient and some are not. So you really want to do due diligence on the tax efficiency of the alternative investments, right? So if they're earning a high investment return but also paying high in taxes, right, that's kind of mitigated, right? So again, you want to look at the risk of the investment as well. Some alternative assets can be riskier than traditional investments. Others can be less risky. It really depends on the asset class, as well as the investment manager who's actually managing the strategy. So they require a lot more due diligence on the asset class and the investment managers because of the relative illiquidity and kind of the specialized expertise involved in managing these assets as opposed to traditional stocks and bonds.